Welcome to the Deep Dive. We're your shortcut to crucial insights shaping the financial world.
Glad to be here.
Today, we're tackling a really big shift. How traditional banks, TradFis, can safely and compliantly team up with virtual asset service providers, or VASPs. We're focusing particularly on stablecoin issuers.
It's a critical area right now.
Absolutely. Our mission for you is to get a quick handle on this mix of, risk and genuine innovation. We'll be drawing on some key guidance and brand new legislation.
And it's moving fast.
It really is. And get this, stablecoin transaction volumes actually blew past networks like Visa and MasterCard back in 2024. That's a huge signal.
It really is. And, historically, TradFis mostly took a de-risking stance, almost like a choke point 2.0, really.
Right. Just avoid the whole sector.
Exactly. The regulatory picture was just too fuzzy. The financial crime risk seemed immense. It was easier to just step back.
But that's clearly not working anymore. So what changed? Why the shift now?
Well, two big things, really. First, you just can't ignore the sheer growth of digital assets, especially stablecoins. There's a real business case now.
Okay.
And second, there's been a noticeable shift, like a philosophical change in U.S. policy, more supportive of digital asset growth, pushing towards a more managed risk approach instead of outright avoidance.
So the why is clear. But the how is tricky. Who helps banks navigate this? I guess groups like the Wolfsburg Group step in here.
Precisely. They're a major player in global financial crime risk. They recently put out guidance specifically on banking fiat-backed stablecoin issuers.
And what's the core idea there?
It's all about a risk-based approach in RBA. Banks need to tailor their controls, specifically to the risks posed by that particular VASP they're dealing with.
Makes sense.
And crucially, the guidance pushes for using new tech. Think of blockchain analytics, AI, machine learning, tools to make monitoring for suspicious activity much more effective. The goal is high-value intelligence for law enforcement, not just ticking boxes.
Okay, so that's the industry guidance. Now, there's actual law backing this up too, right? The Genius Act of 2025, signed just this past July. Sounds pretty major.
Oh, it's landmark legislation. It fundamentally reshapes how TradFi can engage. For starters, it limits who can issue stablecoins, basically. Regulated players like banks, credit unions, and federally licensed non-banks.
Okay, so more control.
Yes. And importantly, it classifies these payment stablecoins explicitly as not securities or commodities.
Yeah.
That keeps them largely out of the SEC or CFTC's sandbox, simplifying things.
That's a big clarification.
What else? It mandates full one-to-one reserves held in low-risk assets, plus monthly public reports on those reserves, which, interestingly, creates new business lines for TradFi's custody, reserve management.
Right. And what's the absolute key part for banks wanting to work with these issuers?
The real game changer, I think, is classifying these permitted issuers as financial institutions under the Bank Secrecy Act, the BSA.
Ah, okay. Why is that so critical?
Because it gives TradFis the legal certainty they desperately needed. Now they know they can apply their existing AML and CFT frameworks, the ones they already use, directly to these relationships. That old uncertainty barrier is largely gone. It also bans interest payments on stablecoins, which helps manage risk.
So connecting the dots here. The Genius Act essentially makes that Wolfsburg guidance truly workable, right? It tackles those old de-risking fears head on.
Exactly right. The regulation provides the bridge, but it's not all smooth sailing. The technical integration itself, using open banking, APIs, that creates a whole new attack surface for banks. It's complex.
So what kind of vulnerabilities should banks be watching out for in these partnerships, like common weak spots?
Yeah, you see things like broken authentication, letting the wrong people in, or injection attacks trying to slip malicious code through APIs, even things like unrestricted resource consumption, where an attacker could overwhelm the system.
And the fixes?
It requires strong security posture. Things like robust authentication, OAuth, JWT's solid input validation to sanitize data coming through APIs, continuous real-time monitoring for weird activity, and rate limiting to stop denial-of-service type attacks. Speed is key here. Automation is essential.
And that's just the tech side. There's still a whole compliance stack on top, isn't there?
Oh, absolutely. Multi-layered. You've got your global AML-CFT standards, like the FATF travel rules sharing data on transfers over $1,000 or euros. Then U.S. rules via FinCEN for transfers over $3,000, plus OFAC sanctions screening, of course.
Okay.
Then there's data privacy. You have to balance collecting all that AML data with rules like GDPR, Secure data handling throughout its life cycle is critical. And cybersecurity frameworks like NIST, especially with its new govern function and ISO 27001, are table stakes, particularly for managing cryptographic keys properly.
So when a bank is doing its homework on a potential VASP partner, the enhanced due diligence or EDD, it sounds like they need more than just the usual paperwork. It's about blending the old and new.
That's exactly it. You need the traditional off-chain stuff, licenses, audits, corporate structure checks, but you absolutely must fuse that with on-chain intelligence.
Like what?
Like screening the VASP's wallets, looking at their transaction history, using blockchain analytics tools to generate risk scores. It gives you a complete picture understanding the entity, both in the traditional financial world and the digital asset world, a holistic view.
Right. So what does this all boil down to for you, our listener? It seems we're in a new phase. It demands a really proactive strategy, doesn't it? One that skillfully blends that traditional compliance know-how with these cutting-edge tools like blockchain analytics.
Precisely. And maybe one final thought to leave you with. This U.S. approach, really spearheaded by the Genius Act, it's clearly aimed at securing U.S. leadership in digital assets, but it's raising eyebrows internationally.
How so?
Well, some international financial leaders are voicing concerns. They worry about potentially increased dollarization of global payments if U.S. dollar stablecoins become dominant, and what that might mean for, global financial stability down the line. It's a powerful move, but one with potentially significant global ripples to consider.
Definitely something to think about. Thanks for joining us on this deep dive.